Hello, good evening. It is Thursday, August 7th, 2025, and it's after the market has closed. It is about 8:30 p.m. Eastern Standard Time. Market has been closed for a few hours. It was a flat day. If you look at the S&P, the Nasdaq was up a bit, and over the last month, the S&P is up just 1.77, which isn't too bad. And for the year to date, the S&P is up 7.79, not bad at all. Over the 1 year, it is up 22%. Hello, Ashley. Very nice to see you. Hopefully you are doing well. Thanks for tuning in. And so the market's been doing well for the last 5 years. If you're a part of the investor class, if you're part of the population that wants to have economic freedom, you're in the right channel. Investing in stocks is a good idea. Just learning how to invest in stocks is the trick. I am a long-term investor. I try to find really good companies that are growing top-line revenue, growing profits, growing cash flows. They have very good balance sheets, and they're growing and will be worth a lot more in the future. I like to buy stocks at a discount when possible. And when we look at it, at least when I look at it, I look at the fundamentals and then value those companies, try to compare them to the current stock prices to see, is it a good bargain right now? Is it a good time to buy that stock? Because if you're patient, you can find great stocks at discounts, even the best ones. NVIDIA was discounted earlier in the year. Meta was discounted. You just go down the list. And of course, as you get smaller caps, those have great potential, but we got to do our homework around those stocks. Got to look at the fundamentals, examine the business, really rationalize what they do for a business. Is it a desirable business? Is it a good stock to have? So if that makes sense to you, let's get into a nice live stream and look at some companies. Looks like Carlos is in the stream. Great to see your name, Carlos. Thanks for joining. We've had so many companies announce earnings. When we look at today, was just overwhelming. 538 companies announced earnings today. Yesterday, 454. Year before, or the day before, 326. So just in 3 days, we've had over 1,300 stocks announce earnings. So the volume's just been massive. And I picked out some stocks that I'd like to see, and some of them are quite interesting. For example, today, Eli Lilly announced, and their stock got just shellacked. And a couple of others that I've got earmarked are really interesting. So we'll take a look at those. Looks like Bad Omen is in. How are you, sir? Good to see you. Ben 10, great to see you. Looks like you have HST. I think is that the Honest Company? And the rules of engagement. If you'd like me to look at a stock, I'll do a deep dive on it. Happy to do it. It's a $5 super chat. If you're a member of the channel, a paid member, you can put a ticker out there and it doesn't cost you anything more because you're already a paid member. So think about it, Ben 10. I'd love to look at HST if you put a $5 super chat on the board. All right, so overall, the market today, we had some winners and some losers. Looks like Apple has been removing the big threat of the U.S. government really forcing tariffs on products that are made in China. Looks like they're probably going to be they're going to be lenient on Apple because Apple's been really kind of partnering with them and kind of investing in the U.S. So over the last 2 days, Apple's done quite well. I think it's up collectively about 8%. Other stocks that were up, looks like Ben 10 with the super chat. Thank you, sir. We'll hit HST first. Looks like the semiconductor complex here, the material providers did really well. Uber went up nicely. I like seeing that. I'm an Uber stockholder. The staples did well today. Financials, boy, It's a little bit of a bloodbath there. Meta came down, but man, Meta's been doing great. This is one we're going to look at later. Eli Lilly, it got really taken down. Utilities had a good day. All right, let's get cracking. We're going to do a full evaluation of HST. Mohammed, good to see you. I am doing well. I hope you're doing well. All right, HST. So this is Host Hotels and Resorts. Host Hotels and Resorts, Inc. is an S&P 500 company. It is the largest lodging real estate investment trust, one of the largest owners of luxury and upper scale hotels. The company owns 76 properties in the United States and 5 properties internationally, totaling approximately 43,400 rooms. The company also holds non-controlling interest in 7 domestic and 1 international joint venture, guided by a disciplined approach to capital allocation and aggressive asset management. The company partners with premium brands. Okay, so it's a real estate investment trust. They've been around for a long time, 98 years. Okay. So the hotel business could be a really good one. How you doing, Brandon? Good to see you. And we can definitely look at Instacart. That's one that I want to look at because it's doing well in the after hours. So let's take a peek. So HST, $10.6 billion market cap company. Over the past year, this stock has gone down 6%. Year to date, down 12.8. Over the 5-year, doing about 42%. So I was saying that the hotel business could be quite lucrative. Your rents are higher because you're renting, each day. It could be profitable. This stock pays a dividend of 0.89%. Real estate investment trusts, REITs, are attractive, especially to older investors that want that income. They may not become the next NVIDIA and go up 20x. That'd be super unusual, but they will deliver income. And you can measure if they could afford that income by looking at the funds from operations. We're gonna do that on this stock. We're also going to look at earnings per share. And we're going to see how they've been growing the revenues. We're going to assess if their hotels are going to do well, if they're going to do poorly. We'll make some calls on that. Investing is both art and science. Most definitely, we're going to look at fundamentals and try to be scientists, kind of have a process. But at certain points, you need to make qualitative decisions. And I'll kind of call those out. It's a judgment call. Not everything is pure science. Like, 3 plus 3 equals 6. Okay, we know that it's 6. We all definitely know that. We can discount free cash flows. We know what that is. But is this business going to do well going forward? I'll let you think about that. Think about the economy, their clientele. These are upper scale hotels. Noodle on that. We'll come back to that question after we look at the fundamentals. PE ratio 16.29. That doesn't seem too expensive. Analysts think it is discounted. All right. That looks okay. Looking at revenue, I like what I'm seeing, which is green on the screen for growth. Now, they probably made some acquisitions back here, 21, 22, although I'll take that back. We had COVID, and lockdowns caused hotels to not allow people to stay there, right? The vacations and so forth. So you had a big reduction in revenue. And then 21, we kind of gradually started to travel. And then we started to travel and we didn't quit. So I'm not going to take these years into account because these only happen once every 100 years. Every time we have a pandemic, we're going to have these unusual numbers. But when we look at 23 and 24, these numbers look really good. 7% and 8% growth. That looks really good. Okay. All right. So these hotels do have expenses. So they're kind of expensive to run. You got to have a staff on site. They check people in and so forth. Their Earnings per share, it looks like it has been growing from 23 to 24, and the trailing 12 months is down a little bit. That may be why the stock price is selling off, is the earnings per share isn't there. I value real estate investment trust by looking at the funds from operations, make sure they can afford the dividend, and then actually try to value the stock if they can afford the dividend based on the dividend rate, as well as the earnings per share. So if their earnings per share is going down, the valuation of the company is going down. So this is rational. Is the stock price selling up for irrational reasons? Well, this would tell me no, the profits are down. So the stock price is coming down. Later on, we'll try to see, is there a problem with the business? We'll look at their financials, see if we can pick up on some problems that are either fixable or not fixable. We'll get to that later. Okay, so that's where we're at with the growth. I like the growth. I don't like that the earnings per share is coming down. So I'm not going to look at cash flow because we don't look at cash flow for real estate investment trust. But I would like to see what analysts have to say. 14 of them cover this stock. There are some analysts that think this stock's worth $22 a share. The worst case scenario, $14 a share. And that's not too bad downside. Seems like the stock sold off. Probably not going to sell off much more. And one thing I would say about this particular market, if these guys are upscale hotels, they are going to attract people that have more discretionary income. And as I, listen into the economic forecast and what's the consumer doing, the consumer toward like the lower income brackets, it seems like they're always struggling, but from what I hear is they're struggling a little bit more. They're looking for more value at the grocery store. Procter and Gamble mentioned that they're when it comes to their brands, consumers are trading down. They're buying less expensive products. Put a period on that. Now let's talk about the higher income consumer. That consumer seems to be doing really well from what I have heard and observed. Those are folks that are, have good occupations, businesses, are investors. You think about investors right now, right? Stocks have been doing great. Crypto's been doing great. So people that are part of the investing, community and have careers and have positions that they make a lot of money, they're going to do great. And they're going to have, they're going to be spending money, and they're going to be spending money on experiences like hotels. So I actually think that the economy is good for this particular for this particular real estate company that runs hotels, upscale hotels. Okay, so as we look at the forecast for this hotel, revenue isn't going to grow very much, but that's okay. Just keep growing a little bit at a time. The earnings per share for sometimes, I guess when people came out of COVID, they were willing to pay whatever the hotel wanted to charge. And I could personally tell you, I went to Europe in 2023, and I had some fun to make up. My wife and I went to Italy, and I pretty much kind of, treated my wife and myself to a really nice trip to Italy. Had a great time, 3 weeks in Italy. And, price is always important, but I probably spent more than I've spent on any vacation, personal record. So I can kind of get that the traveler cooped up for a couple of years and they were like, man, we're going to vacation big. So they were willing to pay more money for these hotels. And now this hotel, maybe it doesn't have the kind of pricing power that they did a couple of years ago up in this earnings per share. But I am seeing that the forecast is saying that eventually they are going to have better years ahead. That looks good. See how the growth in earnings per share is real good in 2028. So that looks pretty decent, a little long term. And we're seeing a stock price that's come down. All right. So fundamentals are there. Now I'm going to go to the website for this company. Stock Analysis does a nice job to bring data together, but I like to be precise when we look at the financials. And you'll see when we look at the income statement and the financials for a real estate investment trust, it looks different than, let's say, a Meta or an Apple. And I'll point the things out. Yeah, man, sign me up. I wouldn't mind being here. That looks really nice. All right, so here are the second quarter earnings call, July 31st. I would just like to see your financials. So I think so this didn't give me the financials. Quarterly results. I think this is going to do the trick. So this is the earnings call, earnings highlights. We're going to start here. We may end up in the financials. Okay. So we company's growing. That's good. I want to look at their financials and see what kind of expenses are increasing, because that might tell us, what is increasing. Is it their salaries are increasing, the pay, or is it something? Give us a tip of what's going on. All right, so this is kind of a infographic slide. So that didn't give me a lot, so I guess we're going to dig in. Hopefully this gives me a lot of good detail. It does, and I know these are all pretty, presentations, but if you look at like Warren Buffett's company, Berkshire Hathaway, no frills, just data, and I prefer that, because then I don't have to go through so many slides. So here's their properties. That looks good. Comparable locations. All right, that's fine. Bear with me. I'm trying to get us to the right financial statement, and then so here's the financial information. Hopefully they give me financials and we'll be good to go. These companies have to secure a lot of debt, and that's normal. So I also treat their balance sheet different compared to a Meta or a different type of business. Now, if they don't give me a financial statement, oh, geez, come on. All right, so I think they're going to have to comply with SEC rules. Let's go to the SEC filings. Should have gone there first. So here's the 10Q. What's good about this is they have to standardize and just report good old-fashioned data. Nice. Okay, good. So we're going to go to the statement of operations. All right, so that's showing up okay. Sorry about the small numbers. All right, total revenue for the quarter, they did grow. They went from 1.4 billion up to 1.586 for the year to date. That's 6 months. It's gone up a couple hundred million. That looks good. These numbers have gone up. So their operating expense went up about 125 million, while revenue went up about 220 million. That looks good. Yeah, I can't see any like big problem there. Interest income. If you see interest rates go down for this company, the stock's going to go up. Like if interest rates go down, I should say, the stock's going to go up because they have so much debt that if you have lower interest rates, they're going to be able to refinance that debt at lower interest rates and pay less income or less interest. You can see here that interest interest expense shows up 50 million and then 58 million. So they were profitable. That's very good. All right, I'm trying to focus in on this and look for funds from operations. This is their balance sheets. And we're not going to look at cash flows. So here's funds from operations, FFO. So for the quarter is 57 cents. Year to date, $1.20. So when we compare that, so we have so year to date we're at $1.20 FFO. All right, good. And then I'll get earnings per share over here. So the expenses, nothing seemed out of whack, like something's bad. They have been losing profitability. It's probably because purchasing power or pricing power, I should say, for their hotel rooms isn't as good as they would like. So we'll use that funds from operations in a valuation exercise we're going to do next. Now I'm going to use the earnings per share in 2026. So that's 78 cents a share. It's not going to grow a lot here, but it is going to grow nicely over here. So I'm going to grow it by 10%. All right, so let's look at a valuation for real estate investment trust. There's a couple different types of companies that I value. There's companies that are most typical, value them on free cash flows. And then there's real estate investment trusts like Care Trust, REIT, and then we're going to look at HST. Then there's banks, and banks, different ballgame. We got to use book value when we look at a bank. So I'm going to use this as kind of a template, and then we'll look at HST, and I'll look at the value of HST by valuing the dividend and the funds from operations and the earnings per share. All right, we got that guy in there. And today is the 7th, 25. All right, so we'll go HST. And the dividend is 90 cents a share. All right, discount rate of 8%, that's fine. These businesses to me seem like a low risk situation because they own assets. They own these hotels. Push comes to shove, they can sell these hotels. And that would be a big infusion of money. So that looks okay. So payout ratio. So the dividend is 90 cents. And is that for the year? It seems a little low. So dividend 90 cents. So that's, it seems low, but that's what it is. So year to date. Okay. So if I annualize funds from operations, it'd be $2.40. And if they pay 90 cents, that's a really low funds from operations. And usually real estate investment trusts, they have to pay out like 75% of funds from operations. So here I'm going to go equals 90 cents divided by $2.40. And what did I do wrong there? 41%. And that seems a little bit off. I'm going to have to double check that. The annual dividend is 90 cents. Stock price should be $25. And so if we measure the value of that dividend, the stock should be priced at $25. And the funds from operations are very good. Funds from operations for a REIT is this is the cash we produce from operations. Now let's take a look at earnings per share. Earnings per share is 78 cents. So this is a growing business. It's not growing all that great. So I'm going to go with 15 PE. That's a decision. Remember, I was saying it's qualitative. You have to make a game time decision. So I would say I'm going to use a 15. If they start growing a little bit better, change it to 16, 17, 18. But you'd never see me take a dividend up to like 25 or 30. That just wouldn't apply because these businesses just don't compound and become massive like a Microsoft. They'll always kind of have this kind of low ceiling. So if we look at the dividend, 41% discount, earnings per share at 25. This can improve. Okay, this can definitely improve. And on average, 19% discount. Now, on a company like this, kind of like where we are with the market, I'd like to see a little better discount. Probably I'd want to see like 25%. And I'd probably, if I was looking for an investment like this, I'd probably be interested in it at a 19% discount. I'd also like to know, how are you guys going to expand your earnings per share? Because if that expands, the value of the company is going to expand. It's rational to see that this stock has been selling off because the earnings per share has been faltering. So this is rational. Like, okay, you're producing lower earnings per share and the market's like, hey, you're worth less because you're not as profitable as we thought. So interesting company. You know, the key to being successful and finding great stocks is having the patience to wait for the right time. And if we look at the history of this stock, we'll go 5-year. It's got lots of volatility, right? So we don't want to buy it way up here and not, well, this every stock was down in April. So this is not a very good data point that I could use as an example. But I would say that it's been selling off. If it keeps selling off and maybe it gets down even further and gives us a better discount, that might be the right move. Because if you bought at the right times, you could probably earn a very good yield through that dividend. And if the stock price goes down, that dividend is going to look even better. And you'll probably make some appreciation. If you look at CTRE, I've tried to do that. And CTRE has been a good stock. Not the best REIT you're going to find out there. There's some other ones that are just freaking solid gold. 1 year, 18.8%, pays a 4% dividend. What's there not to like? It goes up in value, pays me an income. 5 year, it's gone up 75% in value, and it's paid me 4 or 5% each year. You add the dividend to the overall return, I pretty much doubled my money on Care Trust REIT. These guys operate medical, long-term living medical places. So older people, they might have a condition, they may be having to, recover from cancer, and they have to live somewhere for 2, 3, 4, 5, 6 months while they're seeing somebody who's going to care for them. This is the company you'd probably rent out a place from. These guys, I think this is a stock that if you're patient with, you can probably be successful with it. I would like to see them have a direction on their stock, right? Care Trust is a REIT. It has a direction to the stock. It's going up. So Ben 10, great to have you on the channel. Thanks for sponsoring that deep dive into a real estate investment trust. We don't do real estate investment trust that often. I'm glad we did that one. We'll add this one to the repository of valuations. And the next time I update this repository for the members, they could see this and say, hey, what is the deal? What is the story with what HST? And I'll update that later. All right, so next we are moving on to Instacart. And I thought I had it up here somewhere. I guess I didn't. No problem. We'll open it up here. So Maple Bear Instacart. These guys deliver groceries, and I like these businesses. I like Uber, the businesses that are part of this connected planet. Now that everybody has a phone, people want to gig, make a little extra money. They could go deliver groceries for Instacart. They could drive Uber. They can do all kinds of things. And Instacart is that software communication hub that enables that. Now, this isn't showing it, but I know that they were up in the after hours because they announced their earnings. I haven't read their earnings, but I would love to read them because the stock's up 12.33%. I have a feeling that this is going to have a positive ending. It's kind of like, those fairy tales that you read at the bedside for a child. It's going to end well. The good guy's going to win. All right, so let's take a look at CART, investor relations. They must have delivered a lot of groceries, and the market liked that they delivered. These guys are in San Francisco. The guy who started this company, kind of a quirky name, right? Maple Bear. He's from Canada. And he moved to San Francisco because he's like, hey, well, I want to grow my online business. Got to go to San Francisco because that's where the talent is. That's where it's all happening. And he did that. So August 7th, we are dealing with the right shareholder letter. So that's why you have the Maple Bear. Up in Canada, they have delicious maple syrup. And every time I'm up there, I have a little bit. I don't like sweets. I don't like sweet things of that type. But when I'm in Canada, I got to have maple syrup. I got to have some pancakes with maple syrup. Nice cold glass of milk. So that's where the Maple Bear comes, right? Maple, and then in California, we have a grizzly bear on the flag. Maple Bear. That's how he named his company. All right. Grew orders by 17%. Man, that is great. Very good. Now I like that they write a letter. I'm not going to read the letter. I just like to get to financials. So let's see if they're going to give me a nice looking statement that tells me this is what they grew, and that's it. Not a lot of fluff. I got to get to the net. What's going on? What's going on here? Oh, they're delivering for Costco, huh? That's awesome. My wife's been doing this. She's been ordering from Costco, and I can tell you, I love Costco. And I actually, I'm kind of, I'm kind of at a crossroads because I hate the lines. It's crowded because everybody's getting a good deal there. Now, she orders this way, it gets delivered, which is cool. But there's a shopper inside of me, a little one, and I like checking out the stuff at Costco. Like, what kind of really good deals do they have? So I kind of like the convenience of getting stuff delivered, but I still like going to Costco because sometimes they have products that are really well priced, and I just can't resist. I got to buy it. So order volumes went up 17% year over year. Revenue up 11% year over year. Very good. Gross profit up 9%. Okay. So revenue grew nicely. Very good. All right. And they're advertising. So this is what they're doing now, right? They're advertising on the site. So somebody's shopping for their groceries, and they're telling these consumer packaged goods companies, hey, you want to advertise on Instacart because let's say I'm shopping for shaving cream. Well, all the shaving cream companies want to advertise at that moment, like, hey, man, buy our shaving cream or whatever product you're dealing with. That's the kind of innovation they're putting in there. And this, I'm sure, is margin, like pure margin. So that's really smart of them. They should keep expanding that. So that looks good. Cash flow. It didn't go up. Operating cash flow did not go up. It actually came down. EBITDA did go up. They may have made some investments in the business. We'll take a look at that later. The net income did go up. Very good. It almost doubled. Nice job, 92%. Their outlook. So GTV, gross ticket value, is going to go up to 9 billion to 9.1 billion in the third quarter. And I'm not sure what that was before. So I'm going to hit reverse here. Here we go. So they're not going to have high growth in Q3. They're going to grow a little bit according to this number. Because if they're at 9 billion and they're going to go from 9 billion to 9 billion to 9.15 billion, maybe they're putting that out there and they're going to beat and raise. Companies tend to do that. They put like a low target and then they get to it and say, hey, we beat that target we gave you. We're way above that. All right. So now I'm going to pick out the things about Maple Bear that make me a stockholder, frankly. And then we're going to update the valuation. So we got some cash on the balance sheet. We got collectively $1,489,000,000 plus short-term investments of 100 million. So you got about $1.6 billion of cash and short-term securities. Let's go to the debt section. Okay, so here are the liabilities. These are just normal recurring or normal liabilities like accounts payable. They have no debt. I like that. This is a good balance sheet. These guys could operate for a long time without ever being stressed. Okay, so cart, I'm going to make a few notes here. 1489 plus 109. And this is the cash balance, no debt. So no debt, automatically, this is a really good balance sheet. Who wouldn't want a balance sheet with all cash, no debt? All right, so we've got the income statement. Revenue expanded nicely, and year to date, it's gone up from 1.237 billion up to 1.35 billion. Okay, good. Operations and support, see how that number just came down a tiny bit. That's good. Research and development expanded by 10 million. I'm fine with research and development. You got to keep getting better and better and figure out how to integrate that advertising business better. Sales and marketing went up. They're a bigger company. That's fine. Those numbers look good. Looking at net income, it went up for the quarter. It went up really well. That's probably why the stock's jumping up so much. Like the market's like, whoa, you almost doubled your profit. And for the year to date, which would be 6 months, it's gone up nicely. Good job. The shares outstanding, they bought back shares. The share count went down. Now this, I don't freak out over shares increasing a little bit. If they're issuing out to the employees, I actually think that's a good idea. These employees at these startups, they're working 12, 14-hour days, 6, 7 days a week. And if you don't give them equity in the company, they're not going to kill themselves to help you be successful. You need to be, that's just, it just has to happen. Now, if you're like an old company with no innovation and you're issuing out a bunch of stock, well, maybe I would have a problem with that, but not in this industry. These guys are buying back shares. Market probably really like that too. Okay, so cash flows. So cash from operations came down. Let's try to figure out why. Net income was good. Stock-based comp, I just talked about that. I'm fine with that. I have no problem with that. I have some investor friends that have a problem with that. That's fine. They can think that way. That's cool. I'm going to think my way. Accounts receivable, this is a negative number, which means that the accounts receivable number went up. Their customers owe them money. So this is temporary. This will come back. Accounts payable, that means that the accounts payable balance went down. That's also temporary. So I don't think there's anything, nothing wrong going on here. So that's fine. For the year to date, it's a $500 million cash from operations. Now, what kind of capital are we putting back in the business? $34 million. Nicely done. So we've got, I'm going to take this number, 501 minus 34, and that is going to be $467 million. And that's the free cash flow for the first 6 months. All right, we got that number. We got the cash balance, no debt, looks good. Now let's take a look at what forecast these analysts have been having on Maple Bear. It's a $49 stock. There are some people that believe this stock should go higher. On average, they think it's a $53 stock. Well, tomorrow it's going to be a $55 stock. So time to update your price targets. There are some bears around this stock. They think it's a $37 stock. So not a lot of enthusiasm around this stock. We got 22 analysts behind it too. That's a lot of opinions. So next year, they're going to do $2.19 of earnings per share. Now we've got a business that is growing at 11%. And one thing I forgot to show that's really important. I'm going to get to it. Let's get to it now because it's important as we rationalize what should the PE be. So we got a good growing stock, 11%. Now that's not record breaking. You want, insane mode. That's like Palantir and others. These guys, but this is where I really like this stock. Look at this gross margin number, 75%. gross margins. I like that. That's a gross margin number, which enables them to keep growing the business, invest in R&D, invest in that advertising business that advertises as people shop around the store. And they're probably a pretty good acquisition target, by the way. A bigger company acquiring them, maybe even Amazon acquiring them. Then the free cash margin is 23.5. So why did I look at these numbers? Well, if they're growing and they're high margins, high gross margins, and free cash flow producing, then I'm willing to pay a higher price to earnings ratio. That's part of the qualitative kind of exercise, right? So we are at this earnings per share. If the stock continues at the price they're at, it's going to have a P of 22 in FY 2026. I think this stock, the way it's growing, I'd probably go 30, a PE of 30. I think they deserve that because high margins, profitability, doubling profit almost. They're in a good segment of the market. So I'm going to go with 30. All right. We've looked at the fundamentals of Instacart. Let's see what we think, or what I think the stock is worth. Last time I updated that was on May 1st. It is August 7th. Let's update this valuation. I'm presenting it to you. So I'm going to say that, hey, I covered this on video today as well. Now, this is a smaller business. I went 9% discount and growth rate of 10%. I think that's fine because they're growing at 11%. I could even go higher on that, but let's just keep it where it's at. I had originally said cash flow 2024, growing it by 10%. Let's do this. Let's go. I'm going to go 6 months times 2. That's taking the first 6 months and then annualizing it and then growing it. And I should have put here plus growth. All right. So we're going to go with 467 million times 2. That's going to be the annualized free cash flow. And then we're going to go 1 plus the growth rate that we're going with, which is 10%. And I think I got something wrong here. And I should have gone with a plus. So the cash flow is just trending really well here. Okay. They're going to do about $1 billion for 6 months, nearly 500 million. Very believable number. They're trending in that direction. Perfect. Now 9% higher discount rate. The higher the discount rate is the higher the risk. I'm in my valuation, I'm saying I want a higher rate of return. So I'm going to go because I'm taking a higher risk. Instacart is not Amazon. They're not that big. They don't have the network power. It's a good company, but it's a higher risk. So 9%. So when I take this cash forecast, that I'm growing by 10% first 4 years, terminal value 5% growth, I get $27.1 billion of value. The cash on the balance sheet was right around that number. This is 1598. No debt. I like that. No debt. Beautiful. They bought back some shares. That doesn't make a big difference, but you know what? I'm going to give them a thumbs up. You're buying back shares. Good job. You're thinking of the investor. So this, so why am I, so this is, no, that was earnings per share, sorry. So 260.73. me check something real quick. So that is correct. It's actually 262.558. So these cash flows, if I do a net present value, discount all these cash flows, those cash flows are worth 55% more than the current stock price. Now let's look at earnings per share. Earnings per share was going to be $2.19. I had it 24. You know what? I'm going to go 28. 15% growth rate. I'm going to go 10%. So even on earnings per share, it looks good. 48% combined discount. I've been buying Instacart. I'm going to continue to buy Instacart. I like these types of businesses. I own Amazon. I own Alibaba. I own Mercado Libre down in Latin America. I like buying businesses where if I look into the future, are businesses that deliver things going to do well in the future? Absolutely. So Instacart looks good. This will be a nice stock tomorrow. Great job, Instacart. All right. So that one there, and Brandon, you've got access to this valuation before I updated it. It looks better than before because the cash flows got better. And this will be updated in about 2 weeks. But if you need a copy of this, just contact me and I'll send it to you. So thanks for asking about Maple Bear. We're off to the races. Got some good requests. Zubio, what data center stocks? So if you consider that Alphabet Google is a big hyperscaler, that's a data center stock. I own that one. I own Amazon, which is the biggest hyperscaler on the planet. I know that there's some hyperscalers like CoreWeave. I'm afraid of those stocks because if the economy for data centers goes down, those guys are going to go bankrupt. I don't like seeing bad things or scary things. I'm just seeing real things. Look at their debt level. Look at their margins. They don't have very good margins. And that's why I own big infrastructure plays because they have the capacity balance sheets to weather any kind of tough times. DZ Divs 32, what's up, man? It's been a little while. I remember your little logo, the T-Rex with a cape. How much is card up after the after hours? I think 12%. Good to see you, Michael Anthony. Carlos, Hood. All right, let's talk about Hood. Hood did have a good day, and that's because the president signed an executive order saying, hey, people can have Bitcoin in their 401ks. So Robinhood makes a lot of money selling Bitcoin and crypto on their site. Robinhood's also really getting into the 401k market. So those two things really help Robinhood. Up 5%. Robinhood's just been a rocket. Up 198.5% year to date. Up 550% for the 1 year. And these guys own a good part of the future. You think about the investments that are really growing. These guys are in those markets and they have their clientele tends to be younger. And the point I'll make is, younger investors, that's organic growth. They didn't invest before, and now they're investing. And I would say that in a lot of ways, maybe I didn't observe it as well as I'm observing it today, but I would say that investors are getting younger because they realize they're seeing good examples out there of people, getting their financial freedom by investing right, making good incomes, having good careers or businesses. And those young people are going on Robinhood. And young means that they're going to invest for the next 50 years. Whereas it seems like the established brokerages, they're targeting, you know, folks that are 50, 60, 70, 80. Well, those guys are going to expire. You know, they're not going to live 50 years. And I think Robinhood is really taking a pretty fertile part of the market. I really like the stock. I own the stock. It's one of my big positions, not because I put a ton of capital in them, but because they've just been going up like a bottle rocket. So keep going, Robinhood. Just keep going up. I'm good with it. Oh, so you have a Roth with Robinhood. Nice. Good to know, Carlos. See, that's what I'm talking about, man. Investors nowadays are smarter than they were 25, 30 years ago. Part of it is you have so much access to information. I mean, you got 20 sites to look at financial data to pick from. You have YouTubers like myself, you know, putting information there that I think investors would find interesting, research that you would find interesting, you know, because when I was investing 30 years ago, you had to read books. It was not as interesting as it is today. Read books, invest, you get paper statements at the end of the month mailed to you. That was investing. So once a month, you'd like view it and go, oh, cool, this is how I'm doing. It was a very passive endeavor, unless you were a trader on Wall Street. And that was, you know, only a few people would have that type of activity. But now everybody has real-time information. It's great. It's awesome. Good to know that you're with Robinhood, Carlos. Michael Anthony. So you're bullish on Pfizer, huh? So I am cautiously optimistic. I just didn't like their revenue numbers. And man, these guys, just big pharma, this type of big pharma, along with Merck and even Johnson and Johnson, right? If you look at their growth rates, they don't grow. And it's like, man, how come they don't grow? They should be growing. And Pfizer showed like signs of growth, but they didn't go anywhere. But since we're talking about Pfizer, let's talk about Lilly, man, because that is like just is a riddle that I cannot solve. This stock's down 16.99%, but today it did a nosedive. Boom, down 14%. It's a big cap. When it goes down 14, percent, it's like $90 billion of capital leaving the stock. And when you look at the numbers they announced, stock market's a little bit nuts, man. It grew 37% top line revenue. What are their margins? Well, their margins are 84%. Okay. High growth, high margins. Now, they have a diet pill, the weight loss drugs, the injectables, they really worked. And but the things I'm going to point out is they're still growing. Now, the news was that the weight loss drug, they were trying to make it in pill form, and the trials, the data they're getting back is not good. That it's not working as well as the injectable. Got it. It's just the stock got taken down. And the whole space of healthcare, it just seems that the market, at any sign of bad news, it just sells off stocks in a fury. So this stock is down. Now, we talked about Pfizer, and while we're talking about Pfizer and we're talking about Lilly, let's talk about another stock that's gotten shellacked, but it had an interesting day. Novo Nordisk, up 7.45 and up to 1.5 in the after hours. Well, what gives? What's the story here? This thing's down 43%. It seems like it cannot catch a break. Geez, 62% down. This is $213 billion market cap. And when you look at the growth rate of this stock, and this is in a foreign currency, but the growth rate is accurate no matter how you view it, up 21%, the quarterly up 13%. So these are growth numbers. They did reduce their sales forecast, which the market puked on and sold off the stock. And we've got gross margins of 84%. Like I told you guys, I look at like 4 to 6 fundamentals of a company: top line revenue, gross margins, free cash flow, balance sheet. Okay. You give me those numbers, I can tell you I like it or I don't like it. So I got growth on this stock. I got high margins. I've got free cash flow. Okay. All right. I like it. I like it. And I've got a balance sheet. I think they do carry some debt. Let's take a peek. So they carry net debt 12.65, debt to EBITDA of 0.62. This tells me that they could pay off debt in roughly 7 months. That's not a lot of debt. It's a good balance sheet. I like everything about their fundamentals. Wait, it gets even better. Well, what do you mean? The stock's been sold off by 62% over the last year. At some point, this thing's going to turn around because there's just too much value there. If these guys can continue to grow, they're going to be a similar story to, I think like a Netflix. The market, it gets on these runs where it just starts thinking, man, Netflix, these guys are terrible. They're awful. Man, I can't say enough bad things about Netflix. In fact, let's sell off the stock by 73%. And I mean, the market was nuts. I bought the stock. And then the stocks, investors realized, no. Netflix is really good. It's growing, and Netflix is growing like mid-teens. Now it's up 552%. So with patience, we could see when we are seeing really good fundamentals, really good businesses that are going to be around for a long time, just get their prices taken down, and we buy. I buy. And then I see these types of recoveries. I think this might be the NVO story, because NVO, look what they did here. Markets don't do this to a stock unless they see, okay, these guys are growing. They have something that has a lot of value. These things are good. And you go, boom, it came down from the peak to where it's at now, 65%. The last time they were at $48 a share was here, okay? And that's before they went on this run, okay? So this was middle of 2022. I'm going to take a peek at their revenues in 2022, and I'm going to point something out. I think I'm going to point it out. In 2022, and this is in the Danish krone, or I think it's Danish krone. The Danish currency, 170, call it 177 million. Well, fast forward, the business is now 312. So the growth from here to here is like 80%, 80% bigger business for the same price. So there's a lot of value here. I can't tell you when this stock's going to turn around, but I just think that these situations, we saw Netflix. Let's turn our attention to Meta. And Meta did this. Like, stock market was like, oh man, Meta is the most awful business in the world. Zuckerberg's an idiot. Let's discount the stock by 76%. You could have bought Meta for $85 a share. And those that bought when everything was miserable have been compensated 739%. So the opportunity may be knocking on the door. You speak the Danish language. and they're saying, hey, this stock's been just taken down hard, but they have good fundamentals. At some point, I have to think that healthcare is going to turn around. It's going to take a while. It's going to take a while. But back to Pfizer, I'm more excited about Novo than I am about Pfizer. I may sell my Pfizer, just stick to Novo, and but with healthcare, I don't want to be early. I want to be there late. I'm going to wait for these stocks. Maybe I could do this on a chart here, rather than showing up early and going down, because it's hard to imagine they're going to go down even further. But let's compare a couple more. Put Lilly in there. Put Pfizer in there. What other stock do I want to look at? I'll put United Healthcare in there. Kind of like the bruised and beaten. Year to date, all of them coming down. So I don't want to show up early. Like if they start to rally tomorrow, great. Call me if they've been on an uptrend in 2 weeks. That's when I'm going to buy. Because if I show up late, who cares? If you showed up late to Netflix back in the day, you're like, oh man, I missed it. I showed up here. It's been rallying for a while. Who cares? You made 300%. You're good. So I'm going to show up a little bit late, no problem. That means the party got started. Some of the appetizers got eaten. But, kind of like when the party, the music seems to be playing louder. There's, just better energy. That's when I want to show up to this party. I think that's what Novo is going to do eventually, if they can continue with the fundamentals that they have. So that's an extended Pfizer, Novo, Eli Lilly conversation. Interesting stuff happening in healthcare. All right, so we've been going deep on these stocks, talking about this stuff. Thanks everybody for tuning in. We've got a lot of people on the stream. I'm going to kind of do a little bit of a fast, review of the stocks that remain. So we went over Host Hotels. We talked about Maple Bear, Gilead Sciences. These guys are a California company, and they're up 19%, 48% for the 1 year. Here's a healthcare company that's doing well. I thought they announced. Yeah. So why isn't their stock moving? I don't think Stock Analysis is updating the after hours numbers. Yeah, they're up 3.36. Gilead's getting it done. I've looked at this stock. It just never lined up. The stars did not line up for me on this one, but it looks like it's doing well. Catalyst had a miserable day. Stock market's been punishing a small cap. I bought more shares today. Catalyst has been a good stock for me. I think they've had these moments when it sells off. They did have revenue percentage wise that did surprise me to the downside. Like, hey, your revenue didn't grow very well. So we'll see. It can bounce back as it typically does. It attracts investors. They make a lot of money. We talked about Care Trust REIT. Close that guy. Duolingo. This thing was flying up much higher. I thought it was up like 30% in the after hours yesterday. And this is an interesting story because for a while, this is mobile learning, a lot of language learning. And probably a couple of years ago, it was theorized that, AI is going to kill their business. It's not killing anything. These guys continue to grow and grow strong. Good job, Duolingo. Good job. Margins, 72%. Man. Now, I would have chickened out on this one because I would have believed the story that AI is going to disrupt these guys. So if you showed me these numbers and said, you should buy this stock, man, the stock looks good, and you showed it to me here, I'd be like, Can't do it. I think they're going to be disrupted by AI. And I would have been wrong. And all the people that thought otherwise, they're sitting there, happy. Good for them. They deserve it. You take risks, you take the right risk, you see the right picture, you deserve the money. Occidental, Oxy, this is one of my stocks, oil company. Warren Buffett owns it, up 2.47. And if oil prices go up, so does Oxy. Fortinet, shellacked, down 20%. It still is doing well for the 1 year, doing well for the 5 year. But I think this is a crowded space. And I think cyber is a little tricky to invest in these days. I'm not an investor in cyber, but you could say I am because I own Google Alphabet, Microsoft. They have cybersecurity products. So I'm careful with cyber. The last one I owned was Zscaler. I made money, sold it, and I'm good. Man, another super chat. Inta earnings next Tuesday. All right, we got another deep dive. Let's get into it. Fortinet. Good luck. May the force be with you. All right, Inta. Never heard of them. Intap Incorporated, through its subsidiaries, Integration Appliance, provides AI-powered solutions in the United States, the UK, and internationally. Its solutions include Deal Cloud, a deal and relationship management solution that manages client relationships, prospective clients, and investments, current engagements, deal process, operations, and compliance activities, compliance solutions that help firms thoroughly evaluate new business, onboard clients quickly, and monitor relationships for risk through their business. Okay. Let's take a peek at their website. This means that they run on Azure. Okay. Azure has a big cloud, a big infrastructure business. They run on Azure. Proven industry leader. Okay. So I guess these wealth advisors, okay, so they make software specific for professional and financial services firms. Okay, so they do accounting, consulting, investment banking, legal, private capital, real assets. Okay. So an accounting firm would use. Okay. So consulting firm is like an accounting firm. Got it. Investment banking. All right. So they do software. All right. Got it. They probably sell a software as a service product, SaaS, and it's a reoccurring subscription. That's good. It's sticky revenue. I like that. Let's take a look at, now that I know the business, FYI, I've got a lot of experience with software. And 5 year, 43%. Okay. 1 year. And I would tell you that, let me prove this out here. So the software space has not been treated very kindly. Software companies are very profitable. I'm going to show that to you in a bit. Year to date, this stock's down. But is it the only software company the market dislikes? No. Let's put Adobe on there. Let's put Salesforce on there. Salesforce is a very successful, good company. And I think that'll prove the point. See how these software companies are going down together. And I think it's because in technology, a lot of the investing It's like, what's the shiny object? AI. Everything AI is like, oh my God, I gotta own semiconductor. I gotta own, everything that is at the center of AI. And Salesforce, yeah, you got a big AI piece to your software. They call it Agent Force. But yeah, we don't want to pay attention to you. And others like Adobe, they have an AI business. Yeah, we don't want to pay attention to you. So these software companies are really getting ignored. So maybe this is setting up to be a good investment. Let's take a closer look. $3 billion. So I like small caps because small caps can, multiply our money. 3 billion revenue, 483. I'm cool with if no income yet. That's okay. Let's take a look at cash flows. Let's take a look at margins. We can work around that and see through that. So they're not growing fantastically well because they're small. When you're small, 17%, okay, that's good. It's not great because I think Salesforce is gigantic and they're growing, I think 10%. Oh, clicked the wrong one. So Salesforce is gigantic, right? 38 billion. They're growing at 8%. So 8% on 38 billion is like $3 billion of revenue. These guys, 17% on 483, not so much. The quarterly looks good. Pretty consistent. All right, so we've got that. Their margins are going to be about 75%, 73.5. That looks good. So they're already cash flowing. So this is a company will cash flow before they're profitable. That looks good. So the thing that isn't winning me over, I like this cash. I like this cash a lot. If I did this kind of valuation in my head, we're going to go all the way. But let's see how close I am to just kind of putting a target out there. I think this stock's going to be valued at about 2.5 billion, assuming they don't have a bunch of debt. And let me note things here. Free cash flow is $110.74 million. Okay. This one we're just going to value based on free cash flows because they don't have earnings per share yet. Can't value them on that. So this is what's not winning me over, 17.7%. There are other software companies that are growing much faster. And for example, I think we saw what was that company? Not AppLovin, Zetta. So Zetta's come up a couple of times on live streams, as a matter of fact. And see what it did there? It just took off. Okay. Now, this is a $4.6 billion market cap company. I believe they are a software company. Software. Okay. And these guys handle more the marketing and ad placement, analysis, and help businesses market better. Okay. So different, but it's a software company. Okay. Now, these guys are growing at 40%. See, that's like, whoa, that's lighting my fire right there. Like, hey, okay, you have my attention, Zetta. And they announced their earnings, I think, August 5th, and their stock just took off. So back to our Intap. That's why this number is not winning me over, right? If what's cool about live streams and looking at stocks is you could tell, like, hey, this one isn't as red hot as others. But let's continue on. Okay, so we have 17% growth. Cash flow looks good. So I'm going to grow that cash flow by 20%. I'm going to assume they're going to keep growing because they're small. It's expected that they're probably going to grow. Let's take a peek at the balance sheet. So they have very good. They have a lot of cash, very little debt. So they have a cash surplus. Very good. That is what I want to see. You don't want a bunch of debt because that's going to kill you. If you are small and you have hiccups and you have too much debt, you are toast. Not the toast of the town. You are burnt to toast. All right, so I think I have enough to operate with, enough to be dangerous. Let's find where Zetta went. Oh, got to work on my typing skills. Zetta. Okay. So this valued well. And famous last words. We looked at this before the earnings, and I'm like, man, this is a small company. What I would do is I'm going to wait to see the earnings, and then I'll act. And boy, were the earnings good, but that's just the way it goes. I had never heard of the company, so I hate putting my hard-earned money into a stock that I don't know. But I did say that it looked good. All right, so we evaluated on the first. The first was Friday. That's when we looked at Zetta. That's when we did a deep dive. Somebody paid a super chat on Friday, and we looked at Zetta. Should have bought Zetta. Oh man. Well, so this one, what was the name? Intap, excuse me. So this is a smaller business. See how I went 9 on Zetta? But if you looked at Microsoft, it'd be like 7.5 or 8. All right, so trailing 12 months was 110 million. 0.74. I'm going to grow it by 15%, just to make sure we're going to go conservative. 5% growth rate on the terminal value because they're little. I would normally put a 4 there. So the intrinsic value is 4.4 billion. Oh, okay. See, doing it in my head so far has been off. Man. That's why we do the analysis, man. All right, shares outstanding is probably wrong. We got to update that. The shares outstanding, 80.96. So based on free cash flows, this is realistic in my opinion. It's discounted by 37%. And this stock's been, and we're not going to do this because it doesn't have earnings yet, right? So these numbers will be zeros, and we'll ignore this. This is enough. Like Charlie Munger, he only used cash flows. He didn't look at earnings per share. Warren Buffett, cash flows. So that's a good discount. It's not an outrageous discount. I mean, even after Zeta rallied, they're discounted by 35%. So these guys are a little bigger. Their numbers looked a little bit better. Their growth looked a little more sensational. This one here, if you know the space really well and you feel like they're going to go from 17 to 25% growth because this reason, that reason, and this reason, okay, then you might have a knowledge advantage. But man, this one here, I'd have to wait a little bit. I wouldn't want to act too soon. I think we are, so that's where we're at. I think the business looks good. The growth rate didn't win me over because I see other stocks like Zeta that have higher growth rates. And they're going to announce on the 12th, which is on Tuesday. Yeah. Analysts think it's 65% discounted, huh? How many of them? 9 of them. So some people believe, and part of it might be, where have they been? See how high their stock price was, 72? But they have really collapsed. Whew, interesting. So, yep, this is another one where I'd rather arrive to the party a little late on this one before I try to catch this one. Because this is, you've heard of the term, try to catch a falling knife. This is falling. And if they show up on Tuesday and they're like, we're only growing at 12%, this thing's going to go down even more. If they show up and they're like, hey, we're doing better, okay, cool. You got plenty of upside to go. I mean, this stock's going to go to $74 a share. You're at 37. So if you show up a little bit late, who cares? You're still going to go up 50, 80%. That's how I think. You think for yourself, you make your own decisions. You brought up a nice stock, Justin. Thank you so much for the super chat. And if you have any questions, please put them in the chat. So this is Intap, and we'll ignore this number. We're not going to work with that number. 37% discount. I'm going to go ahead and put this one on the watch list as well. That is Inta. All right. All right. Good stuff, man. 2 good super chats tonight. We went deep. Hopefully you found that analysis interesting, Justin. If you have questions now or later, look me up. I'll answer any question you have out there. Michael Anthony, look at GTM, beat earnings, spot shares. What is GTM? Zoom info. Nice. Nice work, man. These guys sell data. Whoa. Small cap, not growing. So the data businesses are getting destroyed. And the one that did catch my attention was Gartner. So Gartner does like opinions on, they're like the Consumer Reports of technology. And these guys are growing, but they got taken down hard today. And this was a lot worse earlier. So 5-day. Whoa, this is what I was referring to. Down 32% over the 5-day. Whew. Bad week. That's a real bad week. Back to Zoom info. These businesses, you think about, geez, you can find so much data. If you go into AI, you can find like so much data that we used to have to pay for because AI pretty much scraped the internet. So you can find all this good data, right? Well, that's killing Zoom info. It's like Zoom info sells like contact information, business information. Well, guys, sorry, but people are all over ChatGPT, uh, Gemini, Grok, Anthropic, and that's the new coolest thing, in the market. So those guys are gonna, I think they're gonna struggle in the future. Airbnb got hit in the face with a shovel, and I'm a stockholder, so I felt the pain. These guys haven't done really well. I thought these guys were going to do better. That's what I get for thinking. They did have good growth for a while, and the growth is slowing down. It's still decent growth, though. I'm going to hang on to my shares. I think this is one of the businesses I like. It's a lot like Uber and a lot like YouTube, frankly, when you think about Airbnb. So these guys had a tough day. DoorDash up 5%. They announced yesterday. Nicely done, DoorDash. I own this stock and I decided I sold toward the end of 2024. I'm like, okay, I'm out. Good luck. May the force be with you, like around here. And it kept going up. I was like, oh no, I left some money on the table, but I did make some money. So I'm not going to cry. And these guys are doing well. Look at that, up 8% in the 5-day. DoorDash, what's incredible is these guys deliver food. They deliver a cheeseburger from McDonald's, they deliver tacos from Taco Bell, you name it. And they're $114 billion market cap. What was the point I was going to make? Okay. So these guys, they don't cook one cheeseburger. But when you compare them to McDonald's, McDonald's is roughly double their market cap. They're 220 billion. DoorDash 114. DoorDash has never cooked one cheeseburger. DoorDash has been around for, I guess, 12 years. And they're already at half of McDonald's market cap. Market cap for McDonald's has been building for like 60 years, 7 years. Company is old. So that's where it's at. It's why is DoorDash so damn valuable? Well, let's look at these margins. 51%. McDonald's, I think they're about the same. 32%. Growth rate, no contest. McDonald's is like, they have to like get in a knife fight to grow 1%. DoorDash, they're just growing very dynamically, 23.78. So it's interesting to compare new business models versus old business models. AppLovin, oh man, look at that. AppLovin, such a winning stock. Look at that. Wow. Incredible. I owned this stock for a while. I talked myself into selling it. So it looks good. Nice job, AppLovin. And this is a very good business. When you look at it's $148 billion market cap. I think they are in the Silicon Valley, right? Palo Alto. Yep. And they help in the marketing area of people putting ads and helping businesses with their marketing. Look at that growth. Oh man, they're just killing it. I think I got off the roller coaster, the rocket ship ride a little too early because I sold like back here. I took my gain and moved on. Man, I should have stuck around. Should have stuck around on that one. But hey, whoever owns it, congratulations. Good job. This is a good business. Really nice growth. I believe their margins are really good. Gross margin 78.6. Good looking business. And that's it. We got through a long list of stocks. We've been rocking for an hour and 34 minutes. Lyft also beat. Okay, cool. Yeah, that's right. The short report. Remember that? Where's that report? Where is that report? So, all right, guys, good stream tonight. Thanks so much for tuning in. And thanks for the two people that bought the super chats. Thanks to the paid members. Really appreciate you. Carlos was on tonight. Brandon, really appreciate your support of the channel. Thank you so much. And I put together on the channel for paid members kind of a demo of basically this sheet and kind of take you around a little bit. I was trying to show, how to search for things and how the formulas work. I hope you find it helpful as you look at my research, because I share my research with the community, and you can look at it 24/7 because it's in a shared folder. Hopefully you find that useful. All right, so that is it, folks. I don't know if the futures are up yet. A little bit in the green, I'll take it. Crypto's up because people are able to buy Bitcoin in their 401ks now. That's cool. That's cool. The new administration's way friendlier to crypto. The administration that's done or gone, um, they just fought crypto tooth and nail. Just they they just they were telling themselves we're protecting the public, the investor. Hey, you know what? You don't need to protect me, man. You don't need to protect me from 596% gains over the last 2.5 years. I don't need you to protect me from that. I need you to go do other stuff like, help with finding cures to diseases and having a strong military and, you know, all kinds of good stuff the government does well. But protecting the investor and not letting us invest in things that we think are going to be good for the future, yeah, just leave it up to us, guys. So very good for the new administration kind of catering to crypto. I think is a really good idea. Crypto's proven itself. Came out in 2008. It's been so many naysayers, and I think crypto's earned a lot of respect, and I think I'm going to say that the longevity that's had, it's just going to keep going up now. Ethereum looks good. I think the whole space and how they're going to try to rebuild a lot of the investing platforms on the rails that the crypto industry has built. That's exciting. That's why I'm invested in Coinbase, Robinhood, but mostly Coinbase for the rails. We'll see where it goes. So that is exciting. And that is it, folks. Thanks for tuning in. Consider being last thing, promise. Consider being a paid member. I think it'll be worth it. You'll advance your skill set, you'll become a better investor, you'll have access to member-only videos, access to my research, access to member calls, as well as on live streams like this one. You can put tickers out there and I'll evaluate them. So take a look. You can just go to my home screen on the YouTube channel, click the join button, and you'll be off to the races. And that's it. Have a good night, everybody. Good luck.